if someone says money is not important, it's all bullshit. Money is important because 90-95% of your problems get taken care with money, and you should have an aspiration, because if you don't have an aspiration, what are you living for? Second is, we believe we are fundamental investors, and therefore we don't invest in loss-making companies. So irrespective of how good the prospects are, we will just not invest in a loss-making companies. And therefore our view is that markets are showing signs of sort of stabilizing, but it's not going to be a V-shape story. I think it is going to be a W-shaped, slow upward trending trajectory. I think at this point of time, don't try and preempt buying something. Don't be in panic and sell something.
Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world. Hello and welcome to the Money Mindset. My guest on the show today is someone I've been chasing for a very long time, and finally is here. Sunil Singhania of Abakkus Investment Managers is here with us. Sunil, thank you so much for being with me on the show.
Sorry you have to chase me. I'm more than welcome on your show anytime when you call me.
No, it's an honor actually to have you here on the show. I've been chatting with you for years now, but in this independent capacity, I'm so happy that you're here.
I'm so happy for you. You're doing very well. Best wishes to you.
Thank you. But the market isn't. So, my objective with this show is to sort of guide that young investor who has just entered the market and not seen a bear market yet, and to cultivate that money mindset, as the show is called, right? So I want to begin with your journey. How did you start, and how has your journey been so far?
So I think the journey has been good, no complaints. But I am born and brought up in Bombay. Studied in a commerce college called NM College, and always was inclined towards numbers. So even while I was in college, I used to read some balance sheets, because that time you had physical balance sheets. So some shares which my father used to own, the balance sheet used to come. So I was very intrigued with that. And the first phase of the IPO boom happened in mid-80s. So that was very fascinating. I applied for the shares of a company, and I got allotted some 500 worth, and it opened at 5,000 rupees. So obviously money is the kicker for that.
Which one was that?
I think Godrej Innovative Chemicals or something, and that got it merged with Godrej Soaps later on. So I think that was a journey. And then, as every commerce student that time used to do, was to do CA. So I did my CA. I was a bright student. I finished my CA when I was 20 years old. And I practiced for a few years as a chartered accountant, but the inclination was always in equity markets and, numbers. So when NSE was planning to start operations, that is the time when I got an opportunity. A gentleman wanted to be a member of NSE, and he needed someone who could give the exam and pass the exam. And that was my lucky entry into equity broking. So I continued, moved to another company, Pashupati Advani. He was my boss for 5-6 years. Together, we used to do institutional broking. And at that point of time, there were not too many brokers with that mindset of doing research. Pashupati had come back from the US. And I think that helped. And when the bear market hit us, which was post 9/11, when the world went into a global recession. Stocks were so cheap, and we used to come out with research reports, and no institution was willing to buy anything. That time I said to myself that I want to be on the buy side. I want to buy shares rather than try to make people buy shares. And luckily, all the mutual funds used to communicate, like I used to communicate with them because they were our clients. And I had 3-4 offers, but that Reliance name was very fascinating at that point of time. So despite being the smallest mutual fund at that point of time, I joined Reliance Mutual Fund. I was there for 15-16 years. So it's not been very eventful. Only Reliance Mutual Fund for 15-16 years, and last 6-7 years of Abakkus. But I think equity fascinated me. Equity still fascinates me, and I'm very sure it will be very, very fascinating. So I think the journey has been good, very eventful. India has grown. Obviously, all of us who have been in equity markets for 2-3 decades have done well.
So you said a couple of things. One is you were born and brought up in Mumbai. Were you born into wealth? I mean, was your family wealthy as you began?
So typical middle class. My father worked in a Birla company for 50 years, first and last job.
Wow.
And we are 5 brothers, sisters. So we were okay. We were not wealthy. Like I traveled in local train till I was like 30.
Okay.
In fact, the first car I bought when my son started to go to school, because at least we wanted to give some comfort to the kids, So it was a comfortable life, but not a wealthy life.
Okay. So do you think the reason I'm asking is because was that hunger to make money something that existed because you were not born into that privilege?
So I would agree that if you aspire to do something because you don't have that, you will work harder for that. And if you already have something, then you become a little bit I would say lax or lenient as far as seriousness is concerned. But I would say that it's not only hunger for money. My view is that if you do things properly and better than the peer set, I think wealth will flow. At least, I have followed that, and that has happened. But yes, you can say that the passion to work hard was there, and maybe because we did not have all the luxuries in the world, maybe that might be the reason. I don't know, but that was definitely there.
So 15, 16 years in Reliance Mutual Fund and then you started Abacus. I don't know. I mean, I've known you throughout, but I think your real art of stock picking came out once you left Reliance and you started Abacus. Is that true? Is that something that, because you had your own outfit, you could kind of put your heart and soul into it?
No, I would say that it was right from the start. Okay. The only thing was that the period of Abacus coincided with lot of new investors coming in. And, when I was in Reliance, maybe there were lakhs of investors. Now there are crores of investors. The whole advent of social media, WhatsApp, forwards, I think that has created, I would say, more awareness.
Hype also.
Post-COVID, stocks just moved like crazy. So that also, leads to more people wanting to know what is happening. And luckily for us, some of our bets did go right. So it always, success breeds followers, it says that. But I think when we were in Reliance, in fact, I remember in 2003 when I joined, I and Madhu were there, and it was a very, very small outfit. As I said, stocks were so cheap, but there were hardly any buyers. And I am still a proponent of balance sheet investing, and even then it was balance sheet investing. The only difference is now there are lakhs like me who follow or read balance sheets. That time there was no one. Technically no one. And we did very, very well in stock picking even at that point of time. And the reason why Reliance Mutual Fund grew from 35 crores only to 35,000 crores in equity assets and 1 lakh crore in equity assets within 5 years, we were like 50% larger than HDFC Mutual Fund in 2008. And we were 35th out of 35 mutual funds in 2003. I think a lot of that had to do with equity performance. And equity performance came out of looking at companies which were off the radar for a lot of investors. So I think stock picking and meeting companies has been the DNA, and I think that is still what keeps me going.
So I was watching a recent presentation you had done somewhere where you said that you don't just allocate money, you look at investments. You are a bit contrarian in that sense. Tell us about your investment philosophy. What are the 4 or 5 things that you stand by when you look at investing in a company?
So Sonia, we all learn, and we learn from our mistakes. So philosophies have also evolved. We have also made mistakes, individually as well as collectively as a team. One thing which we have decided to do is, one, we will not allocate. So the difference is very, I would say thin. But what typically happens is, say if an investor gives us 100, typically the easy way to do it is, okay, Reliance is 9% of the index, make it 7 or make it 11. HDFC is 10% of the index, make it 8 or 12. We don't believe in that. Our view is that independently a company should be in a position to give you returns, and you have to justify that. The returns might be high, low, depending on what category of stocks you're buying and what is your horizon. But we would like to assess every company we have in the portfolio, and we'll just not buy something just because it's in the benchmark or the index. Second is, we believe we are fundamental investors, and therefore we don't invest in loss-making companies. So irrespective of how good the prospects are, we will just not invest in a loss-making companies, because investors who want to take high risk and want to invest in high growth companies, but with a lot of capital burn, they should go to a PE. rather than come to someone who's managing public money. Third is, out of experience, we have learned that discipline of capital allocation is very important. So typically we like to invest in companies where the return on capital employed is at least 14-15%. That would mean that in a bear market like us, even our funds will fall, but we'll have stocks which will fall 10-20%. We will not have stocks which will go to zero. Fourth, obviously, is we believe in in-house research, and we have a large team. That is the reason. In fact, the first thing we did when we set up Abakkus was to build a good team, because that is the learning we got out of our experience at Reliance. And we are long-only investors, and we invest as if we are investing in businesses. So the horizon is at least 3 to 4 years. One thing which we have believed in, and we stand for, is that the best company is not necessarily the best stock. And we had written an article of bubble in quality in 2019, where we had very simply explained that quality companies like Kotak and Bajaj and Asian Paints and so many others, great brands, great companies, you salute those entrepreneurs, salute those companies, but they were not great stocks because they were priced beyond perfection. So I think this is a simple philosophy we follow. So far, so good. It's working. Let's see.
So 2-3 things that stand out for me. One is, you don't invest in loss-making companies. So in today's day and age where there's so much disruption, right? There are companies that have great business models and are the flavor of the season, so to speak. Take quick commerce, for example. There is the Swiggy, Zomatos of the world. Started off loss-making, promised profitability, did very well for investors. You stay away from these sectors entirely?
We will till they turn profitable. Okay. Or at least visibly profitable, So profit should be visible like in the next 1 year, 6 months, not after 5 years. Every company will be profitable after 5 years. Yeah. Because our view is that our mindset is not attuned towards investing in this company. Second, we don't know how to value them. So a lot of these companies are valued on hope, are valued on, a sort of a top-down view that this might happen. So number of orders might go from 1 crore to 10 crores and they'll make that much profit. And as I said, you need a P kind of mindset and a P kind of investor who understands that these stocks can go up and down 50-100% easily. So take the example of Zomato, 75-80 was IPO price, went down to 40, went up to 300, down to 200. The reason there is such a big swing is because there is no way where you can say that 200 is the right price, or 300 is the right price, or 400 is the right price, or 100 is the right price. And I think our view is that maybe there are other investors who know to value these companies better. So let us, let them, participate in them.
So when you say, the other thing you said is that a great company may not necessarily be a great stock. And I completely take that point, because if you look at, say, something like an Asian Paints or something like an HDFC Bank, any of these stocks, right, over a 4-5 year period, they've done nothing for investors. But then there is also this argument that you should stick with good promoters, strong businesses, strong moat, all of that. So how do you manage that, that balance?
So see, returns are a function of multiple things, but one is also about risk and return. So if your return expectation is maybe very, very low, then you can live with very low risk and you will be fine. But if you aspire to participate in India's growth story, and India is thousands and lakhs of companies and entrepreneurs who are trying to do well, I think you will have to go in the broader markets. And a lot of these companies whom now you say that they are good promoters and are very solid, they started small, So ultimately, someone who would have invested in them and taken a call would have done well. However, to mitigate the risks of investing in maybe not as well-known promoter as maybe an HDFC Bank or an Asian Paint is, that is where the parameters come into play. So, profit making, ROC, doubling of profit in 4 to 5 years, that's another criteria we follow, where the profits can double in 4 to 5 years. I think those parameters we also use. So it's possible that some of our companies also would not do well, and that has happened particularly in the last 40-45 days. Correct. But at least we know what we have got into. It's not like a blind kind of a thing.
So when you talk about picking multi-baggers in your portfolio, right? I mean, there are so many that you've identified. Polycab is just one of them. Do you ride these companies despite many years of underperformance? or does the stock move validate your sort of purchase? I'm asking because there are so many companies which have a good run, like Mastech, for example, good run, and then many years of doing nothing. What do you do at such a time?
So see, it's actually a tough call because ultimately, I manage public money.
Yeah.
And
there's an opportunity cost.
Opportunity cost, plus you get compared on a regular basis with your peer set, right? It's on a monthly basis, quarterly basis, 6 monthly basis, 1 year. All investors are long-term investors, but they want returns every week, all across the board. So it's tough. But in a portfolio approach, you can live with it, So there will be some companies where the returns or the performance is instant. You're very lucky about it. Some companies which will have cycles. So our view is that if we are in a good company where profit growth is steady, these cycles will be there. Like, everyone knew that market was overvalued, for example, last year. Even we had companies which were overvalued. But our view was that, yes, the impact cost and the cost of selling and paying tax and then again getting into was not equivalent to the correction which we anticipated. So sometimes you live with it. Sometimes you also live on hope that this quarter is not done well, stock has fallen, but no, the company will do well. Mostly it happens, but a lot of time that hope is hope and hope and hope. Then at some point of time,
it tests your patience.
Yeah, at some point of time you give up, and it happens all the time, frankly.
Can you give me an example? Has it happened with any stock recently?
Many stocks. We had Uniparts, for example. We had Archean Chemicals. Small. Luckily, those bets were very small. We had a company called Hindware where it's been testing. IIFL Finance is a big bet which has tested our patience because earlier they had some issues and again there was some IT thing and so on and so forth. But at least in some cases we are convinced about the promoters. We are convinced about the trajectory of growth. In some companies we say that it's a small position and we don't have too much hope. It's not worth spending that much time. If that much time we spend on something else, we might end up making more. So, it's, as you rightly said, there is a opportunity cost not only in terms of money, but in terms of effort, in terms of time, and in terms of frustration.
Yeah. Patience.
In the morning, if you have 10 stocks and 2 are not doing well, the whole attention goes only on those 2 stocks. At some point of time, you said, "Wow, nikalo isko. Focus on something else."
I thought that only happens to me, but I'm glad that it happens to you also.
We are all human beings. I think emotions are the same. Only thing is, with experience, you try to become a little better with controlling your emotions.
But how do you do that, Sunil? Because, managing your own money is one thing. Managing so much of people's money, how do you balance that greed, fear and all of that? Have you developed some sort of hack for it?
No, there's no hack, frankly. The stress is there for sure. Only thing is, when you're doing this for 20, 25 years, one is, I think you have got better in at least reducing the volatility. Volatility will be there. See, we are broader market investors predominantly. We do have large caps. So in good markets, we will do much better than the market. In corrections, we will fall slightly more than the market, which is a given. If someone says that no, Nifty has fallen only 2-3% in January, that is because so many stocks did not fall, but these stocks for the last 5 years did not rise also.
Yeah.
So if you just single out that 1 month, it's fine. So I think you learn with that. The other thing is your communication with your investors should be very clear. So now for the last 2 years, we have been telling investors, don't expect more than 14-15%, but the returns were 30%. And we were dissuading. In fact, we have not launched a new fund for the last 18 months. Otherwise, earlier, every 12 months, we were launching a fund, because we felt that
it's overvalued.
We didn't want too much money coming in. We launched a private equity fund where we have drawn on only 20%. So technically, it's there. So I think somewhere, you start to learn a little bit. The other thing is just by worrying, things are not going to get better. But at the same time, it is wrong to say that there is no stress. There is stress. You do worry. A lot of times, you do get hassled. And I have seen, the moods also change based on how the markets are doing and how the funds are doing. No one will admit it, but it's a fact.
So you get the bouquets, but you get the brickbats also in greater proportion.
You have to be prepared for that. If someone, so like I'm a little wary of doing too many sales meets and meeting too many investors. But in this 15 days, I've told my guys that whoever wants to, like relevant guys want to talk, I'm there to talk. Because this is a time when you should be talking, you know. In good times, I always tell them whether you want returns or you want to see my face or hear my voice. You can pick one and everyone will pick returns. So that is...
So they'd rather pick returns than see your... If they're seeing your face, then there is definitely a problem.
No, basically, what is our job? Our job is to
Make money.
Research and invest, right? I think that is, so 80% of the time I try to do that.
But where are we at currently? Because, you know, we haven't seen a major correction since COVID, and now people are starting to get worried. I think that optimism is dying a little bit. What stage of this correction/bear market are we in, you think?
So I think it's a very difficult call. The only thing is what happens normally when there's a bear market, after 6-9 months, market starts to stabilize and come up for 2-3 reasons. One is there is a price correction of 10-15%, and there is a time correction of maybe 9 months, 6 months, or 1 year. But in that time frame, normally the corporate profits is to rise by 10-15%. So technically it is to be like a 25-30% correction. This time there has been a 9-month correction of maybe 12-13%, but profit growth has not been there. And therefore, stocks are not as cheap despite this 9-month correction, which used to happen earlier. And therefore, our view is that markets are showing signs of sort of stabilizing, but it's not going to be a V-shaped recovery. I think it is going to be a W-shaped, slow upward trending trajectory rather than a sharp run. The only thing is that there are a few things which might happen. I think earnings growth for December was slightly better than September. It's inching towards 9% so far. We still have a couple of days left. March, if earnings growth come back to 14-15% and if GDP growth comes back to 6.5%, then the future projections will take 15% growth into account, which are right now taking 10%. So the impact will be higher. But otherwise, I think till then, we are for a slow, maybe recovery, more W-shaped, where you'll have ups and downs.
So somebody asked me the other day, a young investor, that what if we see, or what are the odds that we see 2-3 years of a protracted time-wise correction? Then as an investor, what do I do?
So we don't know. It's not happened. Rarely it has happened. So obviously 2001 to 2003 was that period, which was very, very painful, very long. And, you know, Sensex had touched 2600, not Nifty.
Wow.
You know, in 2003. The Sensex was at 2600. You had a similar thing in 2008. But it was because of an event like Lehman, the way you had it in COVID, which was like an event where the price fall was much sharper than what it is today, but the duration was not very long. I think we have not seen a 2-year kind of a phase where markets have just got hammered. I think here also we don't see that, because on Nifty basis, we are now at 17.5, 18 times 1 year forward, which is 10-year average. And if profit growth comes back, then even if the market remains in this range, in 6 months' time, then the PE will look lower.
But do you think profit growth will come back, because domestic consumption has slowed down in a big way, no?
So 3-4 things have happened. One is very clearly because of elections, we lost 5-6 months. New orders from government did not come. The allocation to ministries got deferred because budget was passed in July, and the finance minister has also said that. This year's outlay on capital expenditure has been reduced, but it is still 10 lakhs or something. So the last 3-4 months, huge spending has to happen. We are already seeing ordering. We have to still figure out whether spending is happening or not, because companies will not speak till the earnings season is over, which is going to be in the next 2-3 days. So that is one thing. I was on a personal visit last weekend to some interiors, and you could see vibrations, at least positive side, on the agri side.
Okay.
So that can be the other thing. This tax cut of 1 lakh crore, it will come into effect from next year, but I think it has enough to create some positive buzz, because it is like 1 crore people having 1 lakh rupees on an average extra in their hands. That definitely will have a little bit of a rub-off effect. And I think RBI had controlled loan growth, but since last 2-3 months, we are seeing RBI interested in more liquidity infusion. So we had 1.5 lakh crores of equity infusion The OMOs have been increased from 20,000 to 40,000 crore. We had the first rate cut in almost 3 years. And I think that should also support. But just as a disclaimer, we are always optimistic.
Yeah. I have to talk about that. There's so much chatter now about how, this entire mutual fund community is ever so optimistic. The sun is always shining, but reality
But
is
it
very
has
different.
helped. Last 25, 30 years, whoever has been optimistic, overall, they are the ones who are wealthy and healthy and smiling.
I agree. I'm in that camp, so I agree. But I want to know what is the reality now, because a lot of people, I'm sure you must have read it yourself, saying that, SIPs don't really make you that much money as much as the mutual fund industry is pushing. And then we had S. Narain also come out and say, this is not the best time. Liquidate your small and mid cap funds. How do you react to all of that?
So one is, we are blessed that we have really smart and intelligent people all over. And I think the good thing is that people have different views. Because if you don't have, friends and colleagues with different views, then you don't need so many of them, right? Because if everyone is going to have the same view, then you just need one guest, Your show will be only one guest because everyone will be saying the same thing. It's good. The other thing is everyone has a rationale to it, right? Those who are positive will have a rationale. Those who are negative will have a rationale. Third, there is no denying that a vast majority of stocks, particularly the smaller stocks, were crazily expensive and they continue to be expensive. There is no denying the fact. But as a portfolio manager, what do you need? You need 20, 30 stocks. You need 3, 4 new stocks in a year. I think there we would say that we can still see them. Obviously, multi-baggers are difficult, but whether we can generate a 14, 15% return over the next 5, 7 years, we can still do that. Now, to generate that, whether markets will fall 5, 10% more before they move up or no, that no one has an answer. Okay. But the only flip side is, see, if you sell something what you already have, you are straight away down 15% because of long-term gains which we'll have to pay on it. Then the cost of entry and exit. And the most important, you have to be smart that you sell at the peak and buy at the bottom, both of which are impossible. So I think time and again it has been proven that yes, in the near term, you might be off by 2-3% in case the market corrects or doesn't correct. But ultimately, they also serve who wait and watch. They also will make returns, those who wait and watch. And I think, therefore, for a retail investor, to keep things simple is the best way. And then, if you don't invest in SIP, you will spend that money.
Yeah. So, no, I think the argument is not SIPs. The argument is, invest directly into stocks and, perhaps that will be better. You will be better off than investing into mutual funds. At least that's what the chatter is currently.
I clearly disagree. Okay. I think mutual fund we don't have a mutual fund, but mutual fund is the best way of investing. Most tax efficient way, most simplest way, very transparent. Good professionals by and large. I don't know all of them because I've been out of the industry for 7 years now. But good professionals by and large. And, a proper, I'm presuming proper research-backed investing. As an individual, you will be always at the mercy of someone who will tell you buy this or sell this.
So you don't want to start a mutual fund at some point?
We will soon.
Okay. your PMS is doing really well up until now. But
no, I think, the industry is very dynamic. There is a new asset class which SEBI is proposing, which is the special investment class, 10 lakhs and above. So that's a natural progression for us. But it is how much, you want to run in life.
Bandwidth, yeah.
Bandwidth is not an issue.
I'm going to come to that, about your personal journey and how long you want to run, how much money you want to make. But before that, you're talking about stocks, right? And your investment philosophy. We always talk about the companies that have been multi-baggers for you. But I want to flip the coin now and talk about stocks that have not worked and how do you deal with them. One example maybe is Mastech that we were talking about earlier. Did very well till COVID, but now nothing for last 3-4 years. And IT is going through a very disruptive phase as well. What do you do? Do you keep the conviction going?
1 second, I'm sorry.
Oh, sorry.
End of this question.
Yeah, sure.
Would be resuming. 3, 2, 1,
So, we always talk about winners, but let's also talk about losers. Not losers, but maybe underperformers, because you learn from your mistakes. Mastech. It did well till COVID, but then now nothing for the last 2-3 years. And IT is also in a disruptive phase right now. So how do you react to that?
No, so again, as I said earlier, the companies where obviously near term there are challenges, but optimism continues because they are taking the right steps. I think we hold on to it. And a lot of times what happens, Sonia, sometimes stocks move up far beyond their fair value in a phase of time. And then they normalize. So I think this is a stock where it should not have gone that fast, that much. And that's why you're seeing what you are seeing. I don't think fundamentally there has been too much of a change. Yes, they had 1 or 2 quarters where they did not grow as much as they were growing earlier. There was 1 or 2 quarters where currencies have been swinging up and down, because they are mostly into the British, area. So pound versus dollar, the swings have been like crazy. Even again, dollar has weakened against the rupee, but rupee has appreciated against, dollar has appreciated against the rupee, but rupee has actually appreciated against the British pound and euro and so on and so forth. So there are some reasons to it. So as long as fundamentally we are okay, I think you will live with it. And as I said, in a portfolio, you'll always have 10-15% of your portfolio, which is stocks which are not performing. You have maybe 5-10% of the portfolio stocks which are not performing, where your view is also not positive and where you will find an opportunity to exit. But this is a basket where, yes, stocks are not performing, but we are optimistic about the fundamentals. So I think you will have to just bucket it. So after the results, what we do, we make 3 buckets. Good results, outlook is good. So either we have it or we should have them. Second is outlook, near term was not great, but outlook continues to be positive. Stock has reacted, we should look at them. And third basket is performance has not been good and outlook is also not good.
Okay.
So if you don't have them, smile. If you have them, then find a time and date when you will just, get out of them. Yeah.
Okay. So, okay, that's interesting. What about stocks where the formula is great, but it's still not performing? So I'll give an example, maybe IDFC First Bank, right? Great promoter, good numbers, everything. It was touted to be the next HDFC Bank. I don't know what happened with that one.
You have picked all my, spots of pain.
Because we keep talking about winners, so I thought, we should identify the
so
mistakes.
I think a lot of places, the journey started well, but there have been roadblocks. Roadblocks of 1 quarter, 2 quarter are bearable. But roadblocks which get extended are very painful. Because what happens if a company is doing well, if there's 1 quarter of blip, market will ignore it. 2nd quarter of blip, but if the management is confident, you will have small reaction, but it will be fine. But 3rd quarter, then, people say, aise bolta hai, kuch nahi hone wala hai. Then you start to see the pain. So a lot of these stocks have been in that phase where the blips have lasted for a longer time. Maybe it was an external reason. Maybe for the environment, like if someone is a microfinance or unsecured loan or whatever.
Higher NPAs and all.
And, you have to live with your losers the way you have to live with your winners. The only, as I said, good thing is if you have a diversified portfolio, you can live with the pain and you can live to fight another day.
But you're still hopeful with IDFC First Bank because you still have it in some of your
your
portfolio.
But it's a constant struggle of what you do and when you do. As I said, there will be some places where even if we want to exit, I'm not saying we want to exit, but even if we want to exit, we might wait to find a better time to exit rather than just throwing it away. So you have to just balance it.
Interesting.
And this phase of last 40 days has been a phase where we just want to do minimal because price movements have been so volatile that it just doesn't make sense to do something meaningful because price movements are not entirely because of fundamentals.
Tell me a little more about that. During bear markets, what is the best strategy as a mutual fund and a direct stock investor?
So the best strategy is very, very difficult.
Don't say take a vacation at that time.
No. You can't afford to take a vacation.
There's no money for that.
And if someone clicks and posts in social media, people will say, "Dekho, hum mar rahe hain aur ye maza kar rahe hain." But I think patience, but it's very, very tough. See, the thing is, one has to constantly assess. Because it is possible, as you rightly said, that bear markets might last for a longer time and might go down further. So you have to be aware. If you are an investor of your own money, that time also you are custodian of your wealth. And for people like us, we are custodians of thousands of investors who have relied on us. So you have to constantly assess. So I always have this saying that in bull markets, the time to research reduces and the bet size increases. You research for an hour and you put in 100 crores. In bear market, you research for like 7 days and you put in 5-10 crores. It should be the other way around. But in bear market, I think this is the best time when you should get your basics right, meet companies. Because now the companies will be also very forthcoming. Prices are also in your favor. And you will find 3, 4, 5. See, suppose if something is not worked, it's a mistake. Whether it was due to external factors or your own thing, it's a mistake. You have to ensure that you do something which more than makes up for that mistake. And I think bear market will give you that opportunity to do that. So COVID, for example, 10 became 7 in terms of NAV. Now, you have an option of saying crying, "Arey 10 ka saath ho gaya." The other option is whatever cash you had. Even if you had 10-15% cash, you pick the right stock. Within 1 year, that 10-15 became 30-40. And the 7 became 10. So instead of losing, you are up 30%. If you would have not done anything, then your 7 would have only remained at 10.
Correct.
So I think this is also the time when there can be opportunity. So I think one is the base, whether you want to be an investor in India and whether the long term looks good or not, that has to be very clear. If there is a dent in that thought, then you should exit. But I don't think there's a dent there. It's painful. I would not say it's not painful, but you live with it. And 10-15% reaction is fine.
Because you've seen so many bear markets. So
No,
for
but
you,
from an investor also, if 10 has become 30 or 40, and that 40 has again become 32 or 33, you should not be
that worried. But it's also about timing, right? When you get in.
The same thing happened in N22.
Yeah.
The only difference was price fall was 15% even then.
Correct.
But it lasted for 3-4 months only. The price fall this time also is on an average is that.
15,
only thing
20%.
is there are a lot of stocks where price fall is 40-50%.
But I think the problem is, Sunil, that when retail gets in, they get in at the high. So I'll give you examples, right? Trend, Tata Motors, smaller stocks, Keynes Technology, whatever you want to call it. Great companies, good businesses, good visibility. But retail gets in when the market is in peak bull market. And then the drawdowns start. And then it's for them, it's like 30%, 40% drawdowns, right?
So the best thing for retail is to be mutual funds. But there is a natural attraction and thrill of doing it directly.
Yeah.
But I think, and have a diversified portfolio. See, if you have 20 stocks, maybe even 5 fall 25%, 5 don't fall, 5 fall in line with the index, then you will be down 10-12%. You will not be down 30%. If you have only 2 or 3 stocks and they have fallen 30%, or if you have stocks which you have just bought because someone on Twitter posted it, or some friend told you, or some story was made, which has happened in a lot of smaller companies, then you are destined to disaster.
So coming back to your investment philosophy, you said you don't pick companies which are loss-making. You look at companies where promoters are very strong, where there is some visibility in terms of growth. Great companies may not necessarily be good stocks. What else? What are the other markers that you look at when you identify a company?
So we are value conscious, frankly, very, very value conscious. That doesn't mean that we will not buy relatively higher P stocks, but the growth has to justify that. So we will not buy a 10% growth company at an 80p. We will buy a 20% growth company maybe at a 30-35p. I think that is where we want to be conservative.
Can you give me some examples of companies that you didn't buy because they looked very expensive?
I mentioned all the companies. Asian Paint was growing at 5-10%. The P was 70-80. There were so many multinational companies. Why should multinational companies trade at a premium? Because we've been told that for the last 30 years, all MNCs should trade at a premium.
Correct.
They're great management. They're great companies. They're the worst management. They take so much royalty out of the country. They don't invest anything in manufacturing. They are all marketing companies. And government has reduced the tax to 25%, and they're able to take out more, dividend out of the country. And at first opportunity, they're selling their own shares now. You're seeing that, So I think this myth or not myth, the history, because these companies have done so well in the past, they get higher PE multiple. That should
It
not
doesn't
get
hold
translated.
anymore.
So I think we just follow some basics. I don't think we are extraordinary or great. Every investor will have their own cohort and the way of looking at stocks. We have our own way. Someone else will have their own way. They have also done well. But we would like to invest what we have been taught by books which have been in existence for 100, 200, 300 years. These eyeballs and hope and, number of customers and all, we don't understand.
So value investing, I think, is something that most successful
See,
investors...
only value investing doesn't work.
Okay.
Unless the stock also has growth.
Yeah.
You will
A
not make
combination of
returns.
value and
If you buy a 5p stock with no growth, that will remain at 5p. So you have to mix, some growth at a decent valuation. I think it works.
Okay. What about these buzzing sectors? I know you like to stay away from them, but these days there are buzzing sectors like whether it's EV, whether it's renewable energy, whether it is, I think a year back there was railway, defense, all of that. In general, do you stay away because these sectors get very expensive, or how do you approach them?
So frankly, it's very difficult to stay away. But at the same time, because of all these rules which we have formed for ourselves, invariably we end up either staying away or having very little exposure to them. So themes are always good when they come up, but themes don't last for a long time. And it's not only in India, it's globally. So you mentioned, railways is a great theme, defense is a great theme. But just because a company is in defense, you start to give it 70, 80 P multiple. Just because someone has put a railway picture in their IPO brochure, you start to trade at 70, 80 P. I think that doesn't work. Because broadly, you also have to understand that in defense, you have a single customer, the government of India. Now they cut their budget, this budget, and everything was down 10%.
Right.
So that's a big risk. Second is long gestation. To launch a new product in a defense segment takes 5 years. They will test 2 years in Ladakh, 2 years in Rajasthan, in heat and in cold and all. All this an investor comes to know by experience and by visiting and by trying to understand the businesses. Unfortunately, everyone wants to become rich very, very fast. So no one wants to understand the dynamics of the business. EV is great theme, but are there any real EV companies in India? We have to just, think, because these are all assemblers. Now there are some big guys like Mahindra and Tata who are trying to do something. Otherwise, the EV players are all assemblers. You buy battery from China, you buy motor from someone else. The only thing you make is a steel thing which you can fabricate anywhere. A local. I don't want to be that ruthless, but it's not that difficult. So I think you have to also understand, what is the dynamics, because is there an entry barrier? When the guys like BYD and Tesla and the big guys come in, how many of them are going to be able to survive? And then at what valuation? So there were EV companies which traded at crazy multiple. The IPO came at crazy multiple. It went 2-3x. I think it's now back to below IPO price. Maybe great brand, great initiative, good for the country. But as an investor, you have to also see, even on the solar side, I think great opportunity. I think that is the best thing which can happen to India. If India does what it is doing in renewable, our reliance on oil will reduce. And that would be the biggest positive for the country. If we are able to cut our oil consumption or imports from $200, $250 billion to $150 billion, imagine the rupee will be very stable. You will have no deficit. The government will have a lot of money. And I think that can be the best thing. Again, you go into interior, everywhere you have solar pumps now.
Yeah.
You can see solar everywhere. On the airport's roof, on factory roofs, on parking roofs. That's the best thing to happen.
Any solar companies that you
No, so I was just coming to that. So great theme, but you have to also see what valuations you're giving for what businesses.
Correct.
So modules, for example, you can set up a 1 gigawatt module facility for 150, 200 crore. If someone is doing it in a very sort of a conjuice sort of a manner, you can do it in 100 crores. Now for that 100 crore of investment, can you value that company at 5,000 crores? I think that is where you have to see. So the 1 or 2 year of profit, you discount at peak profit at peak valuation. That is something which is avoidable. So the theme is good. I think there will be opportunities which will come up. But valuations have to be saner, and you have to get into decent companies. Valuations are getting saner. We will invest, definitely. Solar is a big theme. But at the right valuation, not at any valuation. Small companies trading at 10,000, 20,000 crore valuation is crazy. We every day get someone or the other hawking their company. Everyone who comes to sell always has a good thing, If I come to sell you something, even a polyester fabric, I'll tell you is silk. It's like that. So the numbers are huge, and then on top of
the
it, there
promise
was a
is very
huge
high.
FOMO that someone else will buy it.
Yeah.
That is where you have to be careful. So themes are good, but as I said,
Any themes where there is growth potential and valuations are not that high? I mean, themes of the future.
themes of the future, I'm not very sure, frankly, because themes of the future you come to know only when it comes. But I think platforms have potential. See, we are used to it.
Quick commerce, yeah.
Quick commerce or any kind of platform. But valuations have to be there and profitability has to be there. Because the one thing of a booming market is also you breed a lot of competition. So many companies are coming in paints, not to make money out of paints, but because valuation of Asian Paints had become 3 lakh crore. Or many companies will come in quick commerce because Zomato is trading at 3 lakh crore market cap and Swiggy is trading at 1 lakh crore market cap. So, say 5,000 crore invest karo, you'll get a 50,000 crore market cap. So market cap also breeds competition. So a lot of these trends and themes also have a risk of major competition coming in if the markets are very vibrant. So I think power is a great theme. Solar is a great theme. There is absolutely no doubt about it. Data center will be a great theme because of the amount of data we consume. Platforms will be a great theme. But you have to be very smart to pick the best companies in that. And as I said, we are not good in picking stocks which might be profitable in the future. So we just avoid them till they become profitable.
So you're okay to miss out on that little initial part of that rally?
It's a conscious decision, It's a conscious decision. It's fine. So we miss out, but we also save on 9 who make losses, right?
Yeah. You don't have fear. You don't have the FOMO.
FOMO is always there. See, we are human beings, and human beings don't like others doing better than you. That is human nature. So if someone has it and you don't have it, you wait for the day when it reverses, right?
Really? Oh God, I think that's a common problem, yeah. But we should all learn to get over that by now.
I think as human beings, we'll not be able to get over it.
But do you think in the fund management space, it's very obvious? Because I speak to so many fund managers, and everybody's comparing other people's, performances, other people's profits, other people's salaries. I mean, it's crazy. Like,
it's
do you think
nature?
Because everything is out there, I guess.
So too much of transparency leads to all this. But see, at some point of time, yes, at least one good thing about not being in the mutual fund is that you don't have that kind of comparison. But even in PMS and AIF now we have comparison. The other thing is, I think at this stage, it becomes less and less relevant. Maybe for the guy who's like in 30s and 40s, that's even more relevant. Particularly on the money front, I don't think that is as relevant. But I'm a Bollywood fan, and in Three Idiots, when the results come and Amir Khan's name is not there, his 2 friends get very sad, and when his name appears on the top, they get more sad. And there's a dialogue which comes in, dost fail hota to dukh hota hai, first aata to bahut zyada dukh hota hai. So it's like that.
Is that the case in the industry also?
Across, in your industry also, in equities, in film industry, in cricket, I'm very sure whether people say it or not, it's a fact.
But do you still get, after so many years, you personally, do you still get affected by people making more money or less money than you?
Much less than earlier. But I would not say zero, because then I would be lying. We are not sadhus or saints who have taken sannyas and gone to Kumbh. We are human beings. But it's becoming less and less relevant, frankly.
But why is that the case, Sunil, that people who make more money get more insecure about their money? Because I've noticed this across the board.
I don't know about insecurity, but see, beyond a point, what are you living for then? You're living for excelling and being one upon others. I'm presuming that. I don't know whether they're insecure or not.
But that's then a never-ending
But what I've
journey, right?
learned, even with me, when I had 1,000 rupees, I was 100% into equity. When I had 1 lakh, I was 90% in equity. When I had 1 crore, I was 80% in equity. And if I have more, because the notional loss in absolute terms is something which is scary. So if a guy is worth 5,000 crores and there's a drawdown of 15%, बोलता है 750 crore चला गया मेरा. That is what that calculation is scary, because in absolute terms, I'm presuming
You have more
that
to lose.
in absolute terms, not in relative terms
Correct,
or
correct.
percentage terms. It's the same. In fact, you should have more risk appetite when you have more. But as you rightly said, तो फिर बोलता है यार 100 crore side में रख दो, इसको हाथ ही नहीं लगाऊंगा. That thing is there.
But for you, your journey has been phenomenal, right? I mean, you started when you said you've seen the Sensex even at 2,900, and today we're at 80, almost 80,000. So, has your journey impacted your dynamics with money, with the money that you have earned?
I will have to think. Even if I say no, it would have had. So I've always been a little bit balanced. So I have 2 kids. So from start, I had some money which was in fixed income for their education. And I think that percentage has remained more or less the same. Maybe the absolute amount might have increased because wealth has increased, but percentage-wise, it would have remained the same. Good thing about equity investors are most of them are, I would say, very conscious about how they live, how they manage their finances. Most of them, I have not seen a case where you over
They're not
indulge in
extravagant,
something, or you're like all over the place, and you're
But
buying.
why is that the case?
Because most of them have come up
From humble
backgrounds. So they value it. That. And I'm fortunate that I've been in the industry for 25, 30 years. There's so many friends who are colleagues, who have been peers. And, I would say that competitive intensity has been reducing and reducing and reducing because we get so comfortable as human beings. As I said, maybe the new guys who are coming up are going through the phase which we went through. But at least in my close circle, it's very, very nice and very cordial.
It's not very competitive as much as maybe.
No. In fact, we would be happy if someone does well.
Not like the Three Idiots in the
Three Idiots also, they were very close friends, but obviously, it was fact. See, one good thing is whether it's a book or a movie, there will be 2-3 things you will learn out of it. So I love autobiographies. I don't read as much as I earlier used to do, because in 500 rupees, you get to know about only successful person will write an autobiography and will read it. So for 500 rupees, we learn about 25, 30 years of experience of that person. And even if we are able to get 2-3 things out of it, it is worth it.
Correct.
But spend that 500. Don't borrow or don't use this signal copy books.
Buy the original
Buy the
one.
original.
But which is your favorite autobiography? Anything you can share?
I'm reading Elon Musk. It's not a great written book, but it's interesting, But I have had earlier, reminiscences of a stock opera, all the regular books. I used to like that, that Zebra in Lion's Den, because I visited the office 10, 12 years back. I think someone else mentioned about, I think Utpal mentioned about it recently. But when I was in Chicago, I had met this gentleman who had written this book. So there have been on and off pretty good books. Though I should read more, I am not reading as much I used to read earlier.
So if you had to tell me, what is the definition of a life well lived?
It's a philosophy. I don't know whether this is
Because you've been through so much, right? Good times, bad times, big bull markets, big bear markets.
See, I think...
keeping the market knowledge aside.
So, see, everyone has aspirations. But at least I can't spend a lot of money. That might not be true for my family members, but at least I can't spend too much money when it's a nature. And my view is that everyone is born with a particular nature and you should not forcefully try to change your nature. The
Your
other thing
daughter
is,
is sitting right here. She's listening listening to you say, is this a secret message for her that don't spend my money?
I spend a lot of time with her. When I used to go to drop her to school, 10 minutes was my pravachan. She used to call me the pravachan time, where I used to give her doses. Now she escapes from that pravachan. But life will always be complicated and difficult and easy, depending on how you take it, right? For if someone says money is not important, it's all bullshit. Money is important because 95% of your problems get taken care. At least 90% of the problems get taken care with money. And you should have an aspiration, because if you don't have an aspiration, it's not all about money, but growth, fame. You should have an aspiration. Otherwise, what are you living for, right? Everyone would want, you're doing this show, you would be very thrilled if you have more hits, you get more popular. We are running a firm, we'll be very happy if we do well, and then we grow and so on and so forth. Obviously, I would like Abakkus to outlive me. Why should Abakkus be Sunil Singhania only? Abakkus should be Abakkus. No one even remembers who Morgan Stanley is or who Merrill Lynch is. They have outlived them. We should create institutions which outlive you. So everyone should have aspiration, but you should not get obsessed with it, because obsession causes great joy and great sorrow. Because if you're obsessed, then a small, I would say, near-term underperformance would also impact you. And people tell us there is 1 mahina underperformance. Boss, Sachin Tendulkar had an average of 55. We look at the average. In 20 innings, he would have scored a century, and in 20, he would have scored a duck. There would have been phases like what recently cricketers like Rohit Sharma and Virat Kohli have gone through, where there will be a near-term sort of a blip. Now, you can call it a blip, you can call it whatever, but it will happen. I think that will happen in everyone's life. So my view is that don't get obsessed with it, but have aspiration. Work hard. I'm not going to retire till I die. Maybe you'll slow down. And that I learned when I went to Omaha. I took my son along with me 2 years back. And I was lucky because that was the last time when both of them were there. And, seeing their energy, 99 and 92 that time, I said, who's talking about retirement? I'm going to retire in my grave. I wrote a blog also after that. I like to work. And I think everyone should try and work. Maybe, you will not work as much as you would earlier. You would spend time. And obviously, health. Because whatever you have, health is going to be the most important. So we, 5, 6 of our friends, we go for darshan every year. So last weekend we were 29th consecutive year going to the darshan. And,
Where is this?
This is in Salasar predominantly, but Rajasthan, where I come from. But 4 or 5 temples. So we go to Ranthambore and Salasar, Khatu and Junjunu and all. 29 consecutive, we were blessed. Even during COVID, we got 2 windows where we were able to travel. But you're just talking that, say we have 15 more years where we will be physically fit. That is 750 weekends, that's it. So if you start to think about that, and you have
Life
to
is short, yeah.
Yeah, and we give so much time for work. Can't we take out 1 hour, 1.5 hours for health? But we don't regularly. So I think some basic things which we know and we don't do. But otherwise, everyone will have a different perspective. Someone would love what they're doing, which is, just chasing money. Someone else will have some different perspective. But very philosophical question. I don't know how to answer
One
that.
thing that stayed with me is when you said that you find it very hard to spend money, despite making so much of it yourself. Why do you think that is?
I would not say hard to spend money, but hard to blow off money. So even when you are booking tickets, like we are going to Turkey on a holiday, my son who's back from US is planning it. So I was telling him, okay, you and your sister can travel economy.
No way. You can afford the whole flight to take the whole flight on
my wife
business class.
vetoed that.
You can afford to take all of us on business class, Sunil. I mean, come on.
It's a mindset. We were talking mindset. We're not talking affordability.
Of course.
Right?
But why do you think that is? I mean, you've
Because they've
come
been
such a long
brought up
way.
like that.
Yeah.
You're brought up like that. But it will change slowly.
Yeah, with the
Changing
time.
slowly.
your daughter will change that mindset with for you.
We just booked a new car, so it's changing.
Congratulations. But yeah, I mean, this is really a fun experience talking to you. But just, final thoughts on, since we are at a stage where, see, in bull markets, everything looks very good and anything you touch turns to gold. Now, anything you touch turns to dust, So for people out there who are struggling in a big way, seeing drawdowns, 20%, 30% in their portfolio, what's your advice to them?
So my views for the next 7-8 days, don't do anything. And nothing is going to change in 7-8 days because I think a lot of negative news flow is now coming in. But markets are showing signs of consolidation. Trump recently has become the president. Every day there's a new statement. I think the pace of new statements will ebb. He's made a decision and then said, now we'll implement it after 1 month and the second decision and so on and so forth. I don't know when you'll air the show, but Prime Minister is going to be with Trump. Maybe something will come out. We'll get clarity on the pace of growth in this quarter, which is very important. As I said, if this quarter GDP comes back to 6.5% and if profit comes back to 14-15%, then we will have a stable market going forward. And I think most important is there might be news flows which might not be even positive. For example, now with all this news coming in about stopping SIPs and this and that, it is possible that February mutual fund numbers
may not look great.
So there might be a sentimental sort of a thing, which will also will get some clarity in the next 7, 8, 10 days because mutual funds know every day what is coming or not coming. So I think at this point of time, don't try and preempt buying something. Don't be in panic and sell something. The only thing you can do is if you have got into a stock which you feel is a mistake, even now, it makes sense to sell it and buy something good because both would have fallen. Something would have fallen at 30%, something would have fallen 20% maybe. But it's a time to correct your portfolio because the stocks which are not great are not going to bounce back. The stocks which are good will bounce back. I think that is the only thing you can do. Otherwise, at least we are propagating that don't be in a hurry to pump in more money and don't be in a hurry to just sell out. Leverage, I have never believed in. I continue to believe that we should not have leverage when you are investing. Trading, whether it's option, futures, no go. Unfortunately, most of the new guys who are coming in are traders, they're not investors. And I think it's a big lesson to them. It's a good thing because unless you pay tuition fees, you don't learn anything. So I think this is a sort of a tuition fee, because the exchanges are giving you, figures, the brokerages are giving you figures that 93-94% of those who come in lose money and still, we just keep on indulging in that. I think that has to change. It's only in India. I don't think this kind of mass, participation from retail is there anywhere else in the world.
So you were saying that, we're talking about Trump and now all the tariffs that he's announced, etc., right? Because of which we're also seeing currency getting devalued across countries, whether it's China, whether it's in India. Do you think gold as an asset class, which has given great returns up until now, is something that will continue to give returns because of what's happening in the West?
So I always say, the women of India are the best fund managers. We always keep on dissuading people from investing in gold, but gold has been one resilient asset class. So I don't understand gold. The only thing I understand is that gold does well when everything else does not do well. So it's a good hedge. Having said that, how much percent of your wealth will you put in gold? You're not going to put 30, 40, 50%, maybe 5, 10%. But I think the mutual fund has a good product, which is, I think it's balanced advantage or something where
it has a part in gold, multi-asset fund.
It's a good way of
getting
investing.
that exposure.
Because anyway, we don't expect equity to do more than 14-15% CAGR. So if equity was doing 40%, 30%, then it made sense to be 100% in an equity product. Now, if equity is going to do 14-15%, fixed income 7-8%, and maybe gold 10%, the long-term average, then you have a balanced portfolio without sacrificing too much on your returns. So maybe that's a good way of doing it. But gold does well when nothing else does well. Gold has moved up 50% last 2 years. And currency also is a big help.
Correct, correct.
So, but I don't understand. And every equity guy you ask would say no gold. But
But in effect, gold has become
Gold,
the biggest
it's good. And
performer in the
only
last
thing is
10
now
years.
too much money is chasing gold.
Yeah.
I've heard that even in China, people are buying gold.
Because the Chinese central bank is buying so much of gold also.
No, even the retail.
Okay.
Because currency, again, Chinese
Yeah.
currency is also depreciated. So technically, you make the gold dollar return as well as the depreciation return.
Correct. That's similar to what's happening in India as well, because of the way the rupee is moving. The only hedge is because gold is dollar denominated. Hence. Okay, final question then, since we've gone on for a very long time. It was so, so interesting to hear your views. But since your daughter is sitting right here and you've got two beautiful children, of course, they're with you in Abackus as well. If you had to leave one piece of advice for her for the future, what would it be?
Oh. So, I don't know, because, see, everyone will chart their own course. And everyone is different, both of them are different. And unfortunately, as I said, the closest friends and the siblings look up to each other for inspiration, as well as in terms of
competition.
Competition. But they have a good days, in terms of having a good outfit. I think they're good children so far. And
I like the so far.
I think if one works hard, there is no reason why, as I said, Abakkus can outlive the family. And I think that should be the objective. In terms of personal life, touch wood, I think both of them have some, I would say, fragility which has come from me. Not in terms of fragile, but they are not like, they don't overspend or something of that sort, because it's so easy to get carried away, when you have everything. Third is obviously they have both got good education, so they should just build upon it. I think all said and done, you just have to do basics in the most simplistic manner without trying to be very pompous about it or very boastful about it, and then life is sorted.
Okay. Sunil, it was a pleasure speaking to you. I didn't realize our time flew. Thank you so much for being here. And thank you for being with us on the Money Mindset.
Thanks a lot.